Hi all, this is Akshara Menon from PMS Bazaar. Today's webinar is on the topic to have a deep dive into the Aqua PMS strategy, which stands for Adaptive, Quantitative, and Unbiased Alpha Focused Investing. Before giving the podium to Mr. Siddharth Vora, let me give a small brief about him. Siddharth Vora is the fund manager, head of Quant Investment Strategies, and principal officer at PL Asset Management. He's an executive director at PL Group, which he joined 2016 to spearhead the group's foray into quantitative asset management space. He is a SEBI registered research analyst, investment advisor, and portfolio manager. He is also a chartered accountant and CFA Charter holder, and also done his MSc in Business Excellence and with double diploma in World Politics from the University of Warwick in UK. Today, he is one of the youngest fund managers in India and one of the most definite voices of quant investing. Frequently sharing his expert insights at various industry conclaves, business publications, and media channels. It's a pleasure having you to the show, sir.
Thank you so much, Akshara, for that lovely introduction. So hello everyone. Hello everyone. Very good afternoon. Today I'm really excited to take you guys through a very modern and innovative approach to making money, to investing, and to approaching the capital markets. We're going to talk about the Aqua PMS strategy. What Aqua is deriving its name or its inspiration from is water. Water can take any shape, size, form, or color. Similarly, we want an investment strategy also to be as adaptive as water and be able to take any shape, size, form, or color. And in markets, I think the only key to success is adaptability rather than being fixated to one strategy, one style, one sector, one security, etc. And based on our research of the last 30 years in the markets, what we have understood is the moment your portfolio is able to change its colors as per the changing market cycles, as per the changing macro conditions, we have a strategy that can basically adapt to change and respond to change. And because of this inherent adaptability, we've created a strategy for everyone where the focus is on generating alpha for investors, but that alpha is coming out of the adaptive nature of the strategy itself. So with that, I'll just give you all a brief introduction. Aqua is a pioneering style-agnostic and style-adaptive PMS strategy in India. It takes a quantitative approach to investing. We try to eliminate as many investment biases as we can. And the final agenda of all of this is to generate alpha for investors. Alpha simply means outperformance over and above the benchmark. And in an era of man versus machine, with everybody talking about artificial intelligence and machine learning, we still are rooted in the 80 years of legacy of the PL group, which believes that, yes, humans bring a lot of intelligence, a lot of insights to the investing process, and machines bring a lot of discipline, accuracy, speed, and rigor in data analytics. So instead of choosing man or machine, the approach we have taken to investing is a man with machine approach. And we truly believe that a man with machine approach is significantly better than either man or machine in isolation. And I'd like to give you all a brief introduction about our group, the PL Asset Management vertical that I'm looking after. We are pretty much the pioneers in quantitative research and quant-based asset management in the PMS space in India. We take a very differentiated approach to investing using our quant methods. We have a very senior and seasoned investment committee comprising of Dr. Punita Kumar Sinha, Amisha Vora, and other seniors from the industry who are a part of the investment committee. We've created proprietary state-of-the-art technology over the last 5 years in order to test our strategies across macro and market cycles. And all of these strategies are backed by the 8 decades of research expertise that PL brings together. And finally, we've been able to build a very specialized team of quantitative and investment professionals, almost 20 of them. And the team age is between, say, 24 to 32. So it's a very young team. But the qualifications and the backgrounds of the team are something that everybody would be really impressed by. So we have macro analysts, risk analysts, fundamental analysts, technical analysts, software programmers, machine learning engineers, financial engineers, CMTs, CFAs, economists. So it's a whole host of people who come together to make your strategy and to make your investment decisions. So the way we operate is we design the process, the strategy, and the process designs the output or the portfolio. And the performance is driven by the process and not driven by the people. And all our quantitative strategies actually are powered by the smart investment philosophy, because we truly believe, right, in a world where everything is getting smart, right? Smart cars, smartphones, smart TVs, smart appliances. Why not have a smart investment strategy? So the way we look at this is we focus on 5 key things here. All the strategies must be systematically designed. The performance must be measurable across market cycles. The models must be adaptive in nature. So systematic design, measurable performance, adaptive models. The outperformance or alpha that we generate must be repeatable or sustainable in nature. And finally, the attribution to this performance must be transparent. So in a quantitative process, we do have the inherent advantage of having transparent attribution. And I think most of you all would want to understand how a quantitative investing approach really works. So I think we divide it into 5 simple steps, and this is how any broad quantitative strategy should be working. And what I have shared is highlights from the way our quantitative strategy works. So the first layer of a quant strategy is the input that goes in. So this, we're talking about raw data, gathering, cleaning, and organizing the data. So we take data from CMI, Bloomberg, Accord, and multiple other such reputed sources. We collect market data, company data, financial data, and economic data. This becomes the raw data layer or the input layer. The second step is the transformation process. You can't do much with the raw data alone. So you must transform that data into something more meaningful and useful. So what we do here is we build proprietary factors that actually track the markets, the economy, stocks, sectors, etc. So we divide the factors into 3 categories: fundamental factors, technical factors, and regime factors. Fundamental factors cover everything from quality, value, growth, dividend, themes, and size of the company. Technical factors cover everything from momentum, volatility, volume, sentiment, beta, and liquidity. Finally, regime factors cover macros, monetary conditions, sector regimes, style regimes, risk regimes, valuation, and sentiment. So this is the second layer, which becomes very, very important. The third part of the process is the analytics layer. What we do here is we use objective rules, signals, indicators, and parameters to give us an understanding of where we are, say, in the macro cycle. We analyze volatility. We understand which is the current style regime that we're a part of. What are the fundamental parameters and how they add up in terms of stock selection. We evaluate the sentiment of the markets. We rank all the different sectors into categories of strength based on their growth, valuation, technicals, breadth, sentiment, etc. We also get a gauge on risk appetite and valuation. So this is the third layer, which is very, very critical because it uses the output of the second layer to analyze what's going on in the markets, in sectors, in the economy, in the third layer. Finally, the fourth layer is output. What is the output? It's simple. We have to generate a portfolio. So what we try to do here is we try to integrate 6 key dimensions of the portfolio, from the asset allocation in terms of equity cash, to the style selection, to the sector selection, to the size selection, large, mid, small, to what kind of beta we want to use in the portfolio, high, low, moderate. And finally, how do we want to time all of this as the market cycles are dynamic? So our holding period bias should be eliminated in this process. So we try to combine all of this to give you superior performance and also manage risk at the same time. And by doing all of this, the final objective, not just of this strategy, but of any strategy, is to generate sustainable alpha. And in today's day and age, Quant is even more relevant because Quant offers you 3 different features which make it very, very relevant for investors. The first is the sustainability of the performance. Quantitative strategies are run on rules, processes, data, systems, and models, which means there is very low level of subjectivity in your investment decision making, and hence the performance is driven by the process itself, which is more reliable, which is more sustainable than a performance being driven by intuition, experience, gut, or any sort of emotional biases. So quantitative approaches make your performance more sustainable. The second thing is we are able to generate superior alpha and manage risk very dynamically because it is a part of the strategy design itself. And finally, in today's world, there is a very strong synergy between data, technology, and the talent that can mine this data and use this technology. So I think given these three factors, quantitative investing has become very, very relevant in today's day and age. And obviously, there are many benefits of quantitative investing. But to keep this short, I will simply say that we try to eliminate as many emotions out of the investing process. We try to eliminate the biases that come in. We try to keep the transparency very high. So there is no room for subjectivity or ambiguity. All the decisions are made based on data analytics and rigorous testing across market cycles. And our philosophy is that you can trust it only if you can test it. And with that philosophy, we believe a quantitative approach really gives you that confidence to approach the markets and managing money in a very agile way. Finally, better risk management and processing multi-dimensional data. So we're not only looking at price data, we're not only looking at economic data. Price data is too fast, economic data is too slow, fundamental data is somewhere in the middle, alternative data is slightly leading in nature. So we try to combine all the different sources of data to get a holistic multi-dimensional view on the markets, sectors, or stocks. And finally, because quantitative strategy design as a process is not a one-stop process that I've made my strategy and it's over. We continuously try to find areas of improvement. We try to refine our strategies. We try to add new features, and we are always trying to evolve the strategy as the market dynamics are evolving. So I think that edge, the edge of computers, maths, and science combined in one framework really gives us an advantage. And finally, what is the proof of all of this in the world, right? So if I look at US, 35% of all the money is managed quantitatively. 65% of the money is managed actively or passively. In India, the number is close to 1%, which means only 1% of money is managed quantitatively in India as of today versus 35% in US. India is still managing 99% of all the funds actively or passively. And the most interesting fact to see here is in 1989, 89% of the money in US was managed actively. 11% was managed passively. Now come to 2023, 26% only, 89 has come down to 26, only 26% is managed actively, 39% is managed passively, and 35% is managed quantitatively. And even if we look at India, I think the story is building up, and we can see it in the numbers. Over the last decade or so, quantitative funds in India have seen a growth of 232x. Of course, the base is very small given the size of the industry, but the trend or the shift in trend is clearly visible looking at this chart. So in 2020, it was 1,200 crores, 2021, 14,000 crores, 2022, 24,000 crores, in 2023, or 63,000 odd crores. So I think there's a clear shift happening in India as well. And I think the next decade is going to belong to India. Finally, we need to understand why are quant funds gaining market share? I think the simple answer to that is passive funds. The only advantage they offer is they are low in cost, but they are not a product or a strategy for alpha generation. They are going to give you market linked returns at a very low cost. Active funds, on the other hand, are trying to beat the benchmark, are trying to generate alpha, but the cost structures are higher than passive funds. Quant, on the other hand, is trying to keep the cost structure in between, say, active and passive, but trying to give you a return profile which is beating the benchmark. The objective is to generate alpha. So what we've seen in the last 5 years is quantitative funds, 91% of all quant funds in India have outperformed the benchmark in the 5-year period. only 39% of quant active funds have outperformed the benchmark over a 5-year period. So I think the performance itself is the reason why money is moving into quant funds. And the gap, 91% funds outperforming versus just 39% outperforming, that itself is significant enough to transition from a passive active into quantitative funds. Now we delve into the biggest theme of Aqua, which is adaptability. But before we try to understand what is adaptability, let's understand why is adaptability so important. So I've taken 3 examples here. First is asset class and size. Second is investing styles. And the third is sectors. In each of these 3 examples, the case that we're trying to make here is neither one size works consistently across market cycles. Neither one investing style works consistently across market cycles, nor any particular set of sectors do consistently well across market cycles. Market caps, investing styles, and sectors operate in cycles and regimes which keep changing. So there is no one size fits all solution to investing. We need to be able to adapt and tweak our asset class mix, tweak our style mix, and tweak our sector mix. And that is the basis for adaptability. Just to give you an example, say in 2013, a growth style of investing was the best performing style. But in 2014, the growth style of investing was the worst performing style and value was the best performing style. Similarly, in 2015, momentum style of investing was the best performing style. But in 2016, momentum became the worst performing style with a negative 10% return and value was the best performing style. Again, the idea here is every time we look at the best and the worst performing style across cycles, what is very, very evident is that based on the changing market and macro dynamics, the preferred investment style changes. But the problem here is, as an individual fund manager, I'm not able to change my investing style based on the changing market conditions because our style is very inherent to us. It's not something we can change. It's as inherent to us probably as our language. So we cannot really change our investing style. So to break this bottleneck, what we try to do is we take a quantitative approach, a data-driven approach to govern our investment decisions so that we are able to change our investing style as the cycle changes. Even in terms of sector, I think the principle is very, very clear. Only sector rotation as a strategy outperforms across market cycles rather than a buy and hold one particular sector. And even in terms of market cap orientation, I don't think large cap investing, small cap investing, mid cap investing, either of these make sense over a medium to long term because it will see huge periods of underperformance before the outperformance really kicks in. So the recommended approach that we've taken in Aqua is a flexi cap approach, which means we are neither biased towards large, mid or small, but we blend the different market caps in the portfolio. We are diversified across large, mid, small, but we adjust our allocations to each of them based on the market cycle. So for example, in a risk on phase, we would have more allocation to mid and small cap. But in a risk transition phase, our allocation would shift to large and mid cap. And probably in a risk off phase, our allocations would shift to large cap and liquids. So we are adaptive across this dimension of the portfolio. And now, based on the data I just shared with you all, let us talk about a very important feature, which is called multidimensional adaptability. What we're trying to say here is, yes, there are different styles of investing. They are all good on their own, but they don't work across market cycles. So if you're following only a value style of investing, yes, some years you'll do very well, but some years you'll do very badly. But you cannot time it. You cannot time when you will do well and when you will do badly. Similarly, if you're only following a quality style of investing, you cannot control when quality will do well and when it will do badly. So what we have devised is a metrics, three-stop metrics, where we are basically looking at 3 phases of the market in risk on phases, risk off phases, and risk transition phases. What asset does well, what size does well, what style does well, what sector does well, what beta does well, and which factors help you make the right investment decisions. So what this really tells us is that when there is strong growth and liquidity in the markets, it's a risk on phase. Equity as an asset should do very well. Mid and small cap as the market cap mix should do very well. A momentum and small size tilt to your portfolio should add good returns to your portfolio. And investing in cyclical and emerging sectors should be beneficial. And keeping your portfolio beta high is going to add to alpha. And the factors that help you make these decisions in a risk on phase are mostly driven by technicals and sentiment driven factors. In a risk transition phase, on the other hand, we're looking at a scenario where interest rates are rising, inflation is rising, and equity as an asset class would still do well, but probably the size orientation would change to large and mid caps. A style orientation from momentum and small size would change to value or growth, depending on which part of the transition cycle we are on. Rates going up or high rates coming down. If rates are going up, value should do well. If we are coming out of a high rate environment, growth should do well. So your style will depend on which phase of the risk transition we are in. Similarly, when we look at sectors, cyclicals and structural sectors should do better in a risk transition phase. And overall, your portfolio beta should be reducing in this phase of the market cycle. The factors that govern decisions or support decisions in this phase will mostly be fundamental and valuation oriented factors. Finally, in a risk off phase, where there's a lot of uncertainty in growth, there's a bear market that's going on, equity and cash as an asset mix should do better. Size orientation should be towards larger caps. Style orientation should be towards quality, low volatility, and dividend. And sector mix should move towards structural and secular sectors rather than cyclical sectors. And finally, your portfolio beta should be low. In this phase of the cycle, macros and volatility govern most of the decision making rather than technical sentiment, etc. So with this, we want a strategy that can do all of this, right? Change the portfolio, change the asset class, change the size, change the style, change the sector mix, change the beta mix, and use a multi-factor approach while doing this. And that is the reason we believe that we have a strategy that actually focuses on optimizing the multiple dimensions of the portfolio that are actually needed to generate alpha and manage risk at the same time. This is another snapshot of how a single factor approach to investing works versus how a multi-factor approach to investing works versus how an adaptive approach to investing works. So let us take a simple example. Let's look at, say, quality. I think everybody likes to find and stay invested in quality stocks. So over the last 10 years, quality as a factor has delivered a CAGR of 15%. But if you look at a multi-factor approach, which combines quality, value, growth, volatility, momentum, small caps, beta, all of this together, then we are looking at a returns of close to 33% in the same period. So it is very evident that a multi-factor approach to investing will yield better results than any of the single factor approaches to investing. And I think whether we look at dividend at 11%, equal weight at 14%, ESG at 15%, small cap at 18%, value at 15.6%, or low vol at 16%. What is evident is that none of the individual factors are able to outperform a multi-factor approach. Now, the next layer of advancement that we can do in a multi-factor strategy is add adaptability and tilt to this. What this really means is that if we are in a value regime, value as a factor will get more weight compared to all the other factors. So yes, we are still operating in a multi-factor approach, but we are giving more weightages to value or quality or volatility or growth based on the regime we are in. What does a multi-factor approach do? Takes a very simple equal weighted approach to all factors to select stocks. But what does an adaptive approach to investing do? Give more weight to the factor that is currently prevalent in the market. And by doing that, we are able to increase a long-term 10-year CAGR to 39% from 33%. And even when we look at Sortino ratio, which is a fantastic measure of risk-adjusted returns, Sortino ratio measures excess returns divided by downward volatility. So as investors, we are not really concerned with upward volatility. What we are actually concerned with is when prices are going down and there's downward volatility. So Sortino ratio actually measures the excess returns that a strategy has generated divided by the downward volatility that the strategy has experienced. So I think what is very evident here is most of these strategies, single factor strategies, are say at 1, 1.4, some are even at 0.82. A adaptive strategy or a multi-factor, these are the only two strategies which are above 2 in their Sortino ratio. So for every 1 rupee of downward volatility that you experience, you generate more than twice the return, excess return for that. And with that, I think we've set the stage for Aqua as a strategy. I think I've explained you all how we can, change our asset mix, size mix, style mix, sector mix, and factor mix to stay aligned to the changing market and macro regimes. And just a brief overview. This Aqua Fund was launched on the 12th of June 2023. We invested close to 25 to 30 stocks. It is an open-ended flexi cap long only equity PMS. The market cap focus is diversified across large, mid, and small caps. We allocate maximum 4% to a single security at the time of entry. The benchmark is BSE 500 TRI. The investment, minimum investment is 50 lakhs as per the PMS regulations. And the ideal investment horizon in a strategy like this would be 3 to 5 years. The research process that we use for Aqua is a quantamental process, which means it combines fundamental, technical, and macro analytics in order to identify stocks and construct the portfolio. And finally, the objective of this strategy is to generate alpha. Now, a brief few minutes on the investment philosophy. I think this is very important because a lot of people, I hear them all the time talking about or asking me about market predictions. How do we predict a certain stock to do? How do we predict the markets to do? How do we predict the economy to do? But I think based on years of experience and common knowledge, we all know that predictions are usually not right and they usually fail. So we've decided something that in Aqua, the basis of all investment decisions is not to be predictive, but to be responsive. By being responsive, we want to simply do 4 things. Respond to the changing conditions by rebalancing the portfolio, which talks about being adaptive. Respond to data by relying on rules-based and objective systems rather than responding to our gut or emotions. So that's a quantitative way of responding. We want to respond without any biases, either towards the benchmark or towards fundamentals or towards risk levels or towards any investing style. So we want to respond using data, but we want to respond without any biases built into the process. And finally, all the responses that we design or all the responses that we do have a simple goal. Either it improves the return profile or it reduces the risk based on the cycle we are in. If we are in a bull market, the idea is that every response should enhance our returns. And if we are in a bear market, the idea is every response should minimize our risk. And finally, when we do this, we have a strategy that is not only adaptive, but it is also quantitative, unbiased, and focused on alpha generation across market cycles. And a few key pillars which we believe drives the performance is 91% of all investment returns are actually driven by your decision of which asset you want to be in which time. So the right asset at right time is significantly better than holding one asset at all times. And the same applies for size. You can't have one market cap for all the cycles. You should have a large cap approach in a defensive cycle, a mid and small cap approach in an aggressive cycle. Similarly, for investing style, which style you use at which part of the market cycle determines close to 69% of the investment returns. And which sector you invest in which part of the market cycle enhances performance by close to 75%. And the moment you combine multiple factors as opposed to using a single factor, that enhances performance by 80%. And the idea is when you do all of this, you want to select the right securities at the right time. and also ensure that your portfolio beta is changing as per the market conditions, because that essentially helps us in alpha generation and risk management. A little bit on the process that we follow. There are 6 steps to the process. The first step is identify which regime are we in. So we look at macros to identify, are we in an economic expansion, economic contraction, economic consolidation? Are we, from a value perspective, are we very expensive? Are we very cheap? Are we fairly valued? In terms of risk levels, are we in a risk on phase, risk off phase, or a risk transition phase? In terms of size, again, we want to identify which regime we are in. Are we in a large cap regime or in a mid and small regime? In terms of sector, we want to identify whether we are in a cyclical high beta sector regime, a structural moderate beta sector regime, or a secular low beta sector regime. And in terms of monetary conditions, we want to understand whether we are in a high liquidity regime, in a low liquidity regime, in an increasing liquidity regime, or a reducing liquidity regime. So the first step of the process is first determine which regime are we in based on all these conditions. All of this is done quantitatively by our models and not individually by us reading the newspapers or talking to analysts. The second stage is relative evaluation. We use our proprietary factors to evaluate each and every security on the principles of relativity. Relativity simply means how does a particular security rank versus its past, versus its peers, and versus the broader markets on growth metrics, quality metrics, dividend metrics, volatility metrics, liquidity metrics, technical metrics, etc. Finally, we follow a rigorous elimination to clean out all the stocks that are either illiquid or have significant fundamental red flags. So the way we approach this is we start with top 500 by market cap. We eliminate 100 illiquid stocks. We eliminate another 100 stocks based on fundamental red flags. We are left with a universe of 300 stocks across large, mid, and small, which are more liquid than the ones we've eliminated and have better fundamentals than the ones we've eliminated. After we've eliminated, the next step is selection. So we have a robust selection process which combines top-down and bottom-up. So the portfolio construction uses a top-down approach. It tries to align to the macro, sector, style, sentiment, risk, and size regime. So the broader color of the portfolio comes using a top-down approach. But the stock selection happens with a bottom-up approach. So we try to integrate fundamental scores, technical score, valuation score, dividend score, liquidity score, and volatility score in order to select stocks which align with the top-down construct of the portfolio. The next step is once we've selected the 25 to 30 stocks, we need to allocate. So we have a very simple rules-based allocation approach. All stocks get an equal weight, no biases to overweighting one stock or underweighting another stock. None of these weights are coming out of any benchmark orientation, which means this is a highly benchmark agnostic portfolio, and max 4% weight at the time of entry given to all the securities. Again, what we're trying to do here is, in order for the strategy to be sustainable and repeatable, we cannot have biases to individual securities in terms of giving 10, 12, 15% weight to one stock, and that stock drives the returns. What we are essentially trying to do is take an equal weighted approach so that the process itself generates granular returns. We want returns that are granular in nature and not concentrated in nature. And the last step after the portfolio is constructed is responsive rotation. We need to rotate the portfolio. So the portfolio is rebalanced every 2 months, because at the end, we have to stay relevant and stay aligned to market realities. Only then alpha is possible, and only then we can mitigate risks. So when we talk about rotation, there are 3 things we need to understand here. How is the portfolio rotated? It is rotated based on the 6S framework, which we will talk about in just a while. What is the portfolio rebalanced for? It is rebalanced for its asset allocation, size mix, sector exposure, style tilt, beta levels, and security selection. How do we exit stocks in the portfolio? Stocks are exited either based on lower absolute or relative scores. For example, I'm holding, say, 30 stocks in the portfolio. Few of them have deteriorated significantly based on all these quantitative parameters that we track. So they will come out of the portfolio because there is weakness in those stocks. So we eliminate laggards without any biases or any emotions or any attachment. The next thing is some other stocks which are not in my portfolio have gained significant strength in the market based on the quantitative parameters that we're tracking. If so, then they should replace the stocks that have now become weak, and the stronger stocks should replace the weaker stocks. So basically, absolute weakness or relative strength, either of these reasons can cause a portfolio to come in and get out of my portfolio. And every 2 months, we do partial profit booking while riding the winners. So if I have a stock which is at 4%, it goes to 8%. When I'm rebalancing my portfolio, I will bring it back to 4% and hold the position nonetheless, because if we are riding a winner for, say, couple of quarters, at every rebalance, we will at least manage risk and book some profits by neutralizing the weight to the original weight of 4%. A little bit more about the 6S framework. I think this is the heart of the Aqua strategy. The 6S framework is basically a multi-dimensional framework where we look at sector rotation, style alignment to construct the portfolio. We select stocks based on superior fundamentals, sound valuation, and strong technicals. We don't focus on any individual factor in isolation. So we neither want stocks that are only great on a fundamental basis, but on a valuation basis, they're not ranking up, or they are very cheap, but neither fundamentals or technicals are supportive. So ideally, we want stocks that are relatively better than their peers, their past on quality and growth metrics. They are relatively cheaper than their peers, past and markets on a valuation basis, and are showing relatively higher technical strength and favorable risk reward versus their peers and the broader markets. Once we find stocks which meet all three criteria, that is when they come into our portfolio. And the last tenet of the 6S framework is managing risk. We'll talk in more detail also about managing risk here. But in summary, optimal diversification. So we don't want to be over diversified or over concentrated. So it's not a 10 stock or 15 stock portfolio. Neither it is a 40 or 50 stock portfolio. It is optimally diversified. Equal weighted with 4% cap at the time of entry also is a measure of risk management. Eliminating illiquid stocks with inferior fundamentals, dynamically rebalancing the portfolio to change the different dimensions of the portfolio, and being responsive to changing market conditions. All of this is part of the risk management process. And I think I've already covered this in significant detail, but I'll just hold this again if anybody wants to have a closer look at it. So liquidity risk, fundamental risk, allocation risk, we manage by taking a completely unconstrained and benchmark agnostic approach. We manage diversification risk, as I said, by being optimally diversified. And the timing and opportunity risk, which is very, very critical but vastly ignored, is usually done because every 2 months, we're eliminating laggards and replacing them. So we are not emotionally attached to the stocks we own. And the previous, this one is basically how we design for strategic risk management, which means there are some risks that we know on the onset. How do we mitigate those risks? Now, there is another set of risks that are unknown risks. They cannot be dealt with based on a strategic style of risk management. They can only be dealt with using a dynamic risk management approach. So what we do here is, one second. What we do here is we respond to the unknown risks as and when they evolve, as and when they come, using rebalancing. So what we can do, we create up to 50% cash in the portfolio if there is an asset class risk. It's a systemic risk. It's affecting equities globally and in India. And if we are facing that, we try to create cash up to 50%. If there is a market cap or size risk, we try to increase our allocation to large caps. If there is a sector risk, the portfolio automatically moves to defensive sectors. If there is a change in the style regime, say it's moving from value to quality or quality to momentum or momentum to dividend, the portfolio realigns itself to use the new investing style. Finally, if the world is moving from low vol to high vol or high beta to low beta, again, the portfolio's beta is changed to address the beta risk. And finally, if there is any security risk, we simply replace the weak stock or the laggard with another stock to manage stock specific risk. So we use these 6 dimensions of managing risk at a portfolio level in order to respond to unknown risks that arise in the market. And all of this, right, the whole process, the framework, the philosophy, the risk management that we've gone through is backed by 80 years of experience. So we've done serious homework for the last 5 years by leveraging technology, by leveraging the market insights, the investing wisdom of the PL group, which we've garnered over the last 80 years in order to build and design these models. So now we're in an era where technology driven investments, data driven investments are becoming more and more relevant. And we neither want to let go of the research pedigree that we have as a group, nor do we want to not be a part of the new age of investing, which is a tech driven world. And in a world of artificial intelligence, we do believe that we want to combine real intelligence but leverage it with machines. And now the thing that I think most people will be interested in is how is all this adding up in terms of performance. So this is the performance of the strategy till 15th February 2024. Since inception, we've generated close to 59.28% returns. BSE 500, which is the benchmark, has generated 26.26% returns. So versus BSE, we've generated an alpha of 33%. Versus Nifty is generated close to 17.8% returns. So we've generated an alpha of close to 41-42% versus Nifty. But the interesting fact to notice here is there have been 4 rebalances since we've gone live. And in each of those 4 rebalances, our alpha versus the benchmark has been very, very consistent in the 6 to 7% range. So whether we look at the first rebalance, absolute returns of 11.5, benchmark returns of 4.7, alpha of 6.8. Second rebalance, absolute returns of 9.448, benchmark returns of 2.48, but alpha of 7%. Similarly for the third and fourth as well. Even for the third rebalance, we did a 16.75 absolute and a 6% alpha. So the idea is every rebalance is designed in order to improve the chances of alpha generation and do it as consistently as possible. This is the same data represented more visually. And I think before I close out, I would like to just look at how consistent and what are the probabilities of generating alpha in a strategy like this. So this is based on the historic backtested results since 2006. So we have a very, very simple metric of gauging whether we've done right or we've done wrong. If we are outperforming the benchmark for that period, whatever we've done, we've gotten it right. If we are underperforming the benchmark for that period, whatever we've done, we've not got it right, so we've got it wrong. So on a monthly basis, 65% of the times, we outperform the benchmark. But 35% of the times, we underperform the benchmark. On a quarterly basis, 77% of the times, we outperform the benchmark. 23% of the times, we underperform the benchmark. On a yearly basis, we outperform 88%, underperform 12%. On a 3-yearly basis, we outperform 96% and underperform 4%. On a 5-yearly basis, we outperform, as per the data, 100%. We've generated alpha across any 5-year cycle since 2006, and we've not underperformed. And finally, the metric that is relevant to us that we really track is rebalance to rebalance. So on a 2-month cycle of rebalance that we follow in Aqua, we outperform 73% of the times and we underperform 27% of the times. I think these are very, very good ratios in terms of outperformance and underperformance. And finally, this is from our end to see whether we got it right or wrong. But the moment I shift focus to a client, I think clients are mostly concerned with either being positive or outperforming, which means if the client is outperforming the benchmark, the client will be happy. even if the client is not outperforming the benchmark, but his portfolio is positive, it's generating positive returns, the client should be happy. For example, say the benchmark is up 8% and our portfolio is up 6%. I don't think a client would come back with a major complaint. So what we've done is that the second set of metrics we use here actually looks at our performance from a client's perspective. So if we are outperforming a positive, or we are underperforming and negative. I think underperforming and negative is a very, very bad situation to be in, which means I'm also underperforming the benchmark and I'm also delivering absolute negative returns. Let us shift focus to this metric because this is the pain point of investors and wealth managers for that matter. So on a monthly basis, 17% of the times, yes, we do underperform and we deliver negative returns. Quarterly basis, 15%. Yearly basis, 4%, 3-year basis, 5-year basis, 0. And on a rebal to rebal basis, 12% of all the instances, we will be underperforming and giving negative returns. But 88% of the times, our rebalances will either yield an outperforming result or a positive result. And this can also be seen in the life portfolio, where almost 65 to 95% of the stocks have been positive in each of the rebalances, and 64 to 84% of the stocks have actually outperformed the benchmark in each rebalance period. So when I'm talking about a total portfolio approach, we are essentially saying that we need granular returns that are repeatable rather than concentrated results generated by 1, 2, or 3 stocks. And I think the data of the portfolio itself clearly suggests that the returns are well scattered and spread out between a host of stocks rather than just a few stocks. And what we always tell all our investors is that don't look at any portfolio or any strategy either as a size or like a large cap, mid cap, small cap, or which stocks it owns or which sectors it is invested in. Finally, as an investor, you are giving your capital for your capital to grow. If you want your capital to grow in line with markets, passive funds, ETFs are very good. But if you want your capital to grow at a faster clip than markets, then you should be investing in strategies that are focused on alpha and designed for alpha. Because the final outcome that you take back home is the returns, is the risk of that portfolio, neither the securities, nor the stories, nor the theories, nor the narratives. You're not taking any of that home. That is just for your mental or emotional satisfaction. That is just knowledge that you gain along the way. But your actual agenda of investing is outperformance, is alpha. And I think in the ticket size that PMS operates in, I don't see many investors who want to come in just to get market-linked returns. So in the 50 lakh and above ticket size, most of the investors are seeking alpha and chasing alpha. And therefore, evaluating any strategy or any portfolio with a total portfolio approach, looking at granularity, looking at outperformance, looking at underperformance, looking at Sortino ratios is the only way to understand how a strategy is doing, rather than getting emotionally attached to the stocks that the fund is owning or any of that. And this is just a quick representation of how our portfolio has been in action. The first dimension of the portfolio is how we've dynamically allocated across the different asset classes, whether it's large cap, mid cap, or small cap. This is a quick image since 2006 to 2023. Again, the idea is not really to go in details of each cycle, but it's more to understand that, yes, this is a truly flexi cap strategy, which can change its exposure to the different asset classes. But despite being flexible and dynamic, if you look at the long-term average of our fund, it's a fairly well-diversified strategy with 30% large cap, 37% mid cap, and 33% small cap. So it's almost a balanced, diversified portfolio across the 3 M caps. Even if I look at my asset allocation, and now that has been dynamic, we can see periods that we've created cash in the portfolio to mitigate or deal with market events and market risks, whether it's the 2008 cycle, 2011, in 2020, or at some points of 2022. The portfolio has been able to create cash as well to reduce risk for investors. The next dimension of the portfolio is the style. Again, what is important to see is that since 2006 to 2023, there have been multiple changes where styles have evolved, where styles have changed, and how the Aqua portfolio has responded to those style regimes. And I think it's a good blend that we've seen over the last 15 years of using quality, of using growth, of using value, and of using momentum in different cycles and different phases to manage risk and generate alpha. And the other dimension of the portfolio, as I said, was sector rotation. Again, this is a representation of all the sector rotation we've done since February 2020. And I think what is very evident, these returns that we see, that the 59% return, the 35-40% sort of alpha, that is attributable to our overweight on cyclicals, industrials, the PSU pack till December, Jan, and the energy pack. So we've overweighted all of these sectors to a huge extent as opposed to the benchmark. We've also eliminated private banks, agrochem, chemicals, IT till December. We've now had zero exposure to all these sectors and themes. In financials, we've had a weight of close to 30-33% since say July to January. But the financial exposure was taken through stocks such as NBFCs, PSU banks, PFC, REC, asset management companies such as probably HDFC and Nippon, capital market plays, broking companies, and exchanges such as BSE. So if our allocation to financials is high, it's still coming from a very different sort of names and sectors. So it's a diversified financial allocation. And when we talk about the industrials theme, we're talking about capital goods, defense, railway, shipping, infrastructure, ports, all of it. So bulk of the alpha that we've generated has come from our exposure to industrials, energy and utilities, and automobiles till November. And now gradually the portfolio has shifted its allocation to slightly more defensive sectors such as healthcare, utilities, a gradual build-up in IT as well. And over the last 1 month, our size allocation has also shifted from mid and small cap focused to large cap focused. We are now at 50% large cap allocation. Similarly, the beta of the portfolio is also dynamic across market cycles. We have been a high beta strategy in bull markets. We've been a low beta strategy in bear markets. And we've been a moderate beta strategy in transition markets. And these are some of the key names that have contributed to significant returns in the Aqua portfolio till now. This is not necessarily showing the stocks that we own today. This is simply showing the stocks that have come in the portfolio, delivered healthy returns, and probably have gone out of the portfolio by now. So we've got BSE delivering 225% returns, Cochin Shipyard 176%, IRCON 174, PFC 123, REC, GMDC, Apar Industries, Schneider Electric, Adani Power. So we're not agnostic to even Adani Group. If the Adani stocks are coming in the portfolio at a particular point of the cycle and they're generating healthy returns for the strategy, we're happy to own them. And if the Adani stocks are coming in an adverse cycle, that's when the risk management and the elimination process should make sure that they don't come into our portfolio. And fortunately, when the whole Adani fiasco happened, we did not own a single Adani stock in the portfolio, because the way we evaluate stocks based on risk, liquidity, technicals, fundamentals, valuations, etc., all those factors combined need to add up to Adani coming in the portfolio. And at that cycle, it wasn't there in the portfolio. So this is just a quick representation. And finally, this is the team that backs all the work that we do. As I said, it's a multidisciplinary team from data scientists to technical analysts, financial engineers, statisticians, mathematicians, risk analysts, fundamental analysts. And this is pretty much it, guys. And I truly believe that what Google Maps did to navigation over the last 20 years, quantitative investing and quantitative techniques hold the potential to do that to investing. And with that, I would like to actually open the floor for a Q&A.
Yeah. Thank Thank you, sir. Thanks a lot for this wonderful PPT. So I have got less time for Q&A, but quickly, I just have one question to ask you before I could jump on to the audience question. When you said you had rebalanced it 4 times in like last 7-8 months, so how was the churn ratio managed in the portfolio, sir?
So on an average, so long-term averages are close to 35 to 40% churn ratio. Every 2 months, 35 to 40% of the portfolio gets churned. But sometimes we could have a churn at 20, 25%. Sometimes it could be at 50, 60% as well. But we're not, I'll tell you, we're not very concerned with churn. Neither do we have any holding period bias as such. That's not the way we want to operate the strategy. A stock should come in based on its merit, and it should be held till those merits last. The moment the merit starts reducing, the stock should be out of the portfolio. We don't believe that long-term investing is the right way or short-term investing is the right way. We are agnostic to the time period completely. So some stocks are held for 8 months, 12 months, 24 months. Some stocks are churned out in 2 months or 4 months also. So point is not to be focused on the time period of holding because that is a bias. Let the data govern the decision rather than me saying I want to hold it for 2 years.
Okay. So even feeling is also biased to a particular stock. That's true. And one more thing, what do you think that will be a USP, like a unique selling point of Prabhudas Lilladher when compared to other quant strategies available in the market?
I think after this whole presentation, if you're still asking me for a USP, that means I've not really explained my strategy well.
No, this is very first question asked by Raghav. So I just want to make that clear.
See, I think USP could be evaluated in 3 terms only. One is the returns, one is the risk, and third is the process. So in terms of returns, I think the numbers speak for themselves. I think they're very healthy returns. In terms of risk, we've had months like August and we've had months like October where the markets have been down, but Aqua has been up and doing very well. So in October, I think markets were down 2-3%. Aqua was up 6-7%. In August, markets were flat and Aqua was up again 4-5%. So the whole idea is, if you believe that this performance that we've generated is backed by a very solid process, which is backed by a very solid team, that process itself is the USP. Our ability to understand complicated markets and simplify them using our rules, using our methods, that is the USP.
That's true. Thank you, sir. And moving to the next question from Ramachandra, he asked like how AI and algo trading helps making gains in following market, and how Aqua is better than the other AI PMS in the market.
So, okay, this is neither AI nor algo. AI uses artificial intelligence to make investment decisions. We are using real intelligence, but in a quantitative manner. So real intelligence gives us the rules we need to design, the frameworks we need to use, the process we need to use. But once we come up with the process, we use the machines to actually code it, test it, and implement it. So this is not an artificial intelligence fund. This is real intelligence powered with machines. Second question is algo. So algo and quant is very, very different. Algo is one unit of rule. It's one single individual rule. A quant strategy has 3,000-4,000 algos working together to make investment decisions. An algo could be as simple as buy a stock when the 50-day moving average crosses the 200-day moving average. Sell the stock when the 50-day moving average crosses below the 200-day moving. That's an algorithm. We have fundamental, technical, macro, sentiment, sector, style, risk, liquidity. Each of these parameters have 70-80 sub-parameters. So it is running into 3,000-4,000 algorithms working together to make your investment decisions rather than a single individual algorithm.
As your tag says, man with machine. That's how it works. And the next question from Raghav was like, most of the times research companies gives more bearish view on bad markets and bullish view on bull markets. And it seems like one is copying the other report. How do you filter the quality from research ocean?
Research reports. We don't read any research reports. We don't rely on any research reports in quantitative investing. We rely purely on the data that is fed into our systems. They make all the decisions. And just to give you a realistic view, we were in a risk on phase for 23. In 2022, we were in a risk off phase. And in 2024, we are approaching a risk transition phase. So we are neither bullish nor bearish. We are not concerned with giving you any positive or negative view. We are concerned with being very realistic about what is happening in the markets and let the data tell us what is happening in the markets rather than my feelings telling you what's happening in the market.
Okay.
So we don't read research reports to make investment decisions.
And the next question is that being it is a quant strategy, what is the role of a fund manager in the whole process? So which part of the process where the fund manager's intervention is required?
Okay. So over the last 5 years, building the team that is now running this whole strategy is the role of the fund manager. Designing the strategy is the role of the fund manager. Defining the inputs, the process, the factors, the output, the risk measurement, all of that is the role of the fund manager. Once the strategy is live, monitoring the portfolios daily, seeing what is working, what is not working, what improvements can be made in the process, that is the role of the fund manager. So the fund manager plays a really significant role in defining the processes, designing the strategy, and ensuring that the team behind this is strong. But what the fund manager doesn't do is tamper with the processes, tamper with the output, or tamper with the stock selection that is generated with the quantitative systems.
And yeah, that's true. And moving on to the next question, like from Mandar, and he has an all-time high index, all-time high mid-cap, small-cap valuations. Do you still see opportunity in the market to generate returns like historical?
So I think in the mid and small cap space, more than 65 to 70% stocks are trading, say, one standard deviation above their historical valuations. But in the large cap space, I don't think we are very overvalued, to be honest. I think there is still enough headroom for the large cap pack of the market to do well. And as I said, finding one time of the market that markets are overvalued and not investing at all is not the solution to sustainable wealth creation. How to adapt to that time period and change your portfolio and respond to the changing market conditions is the only way to sustainably generate alpha. For example, in the life portfolio, we've increased our large cap allocation from 25% to 50%. That's a 100% increase in the large cap allocation. We've moved our sector allocation to a more well scattered sector allocation rather than a very concentrated sector allocation. We've reduced the portfolio beta by 25-30%. So we will not stop investing because the markets are high. We will respond to the fact that the markets are high, the risk is higher. How to mitigate this risk? By probably having more value orientation, more volatility orientation, more dividend orientation in the portfolio.
Yeah. So I'll quickly take the next question.
And to answer his question, alpha is not generated only in bull markets. When markets are rising, you make more money or you make more returns than the market, and that is alpha. When markets are falling, you are more defensive than the markets, you also make alpha. But when you do this repeatedly across market cycles, your alpha compounds and adds up. So there is nothing like long-term investment or long-term alpha. Long-term is made up of so many short-terms. If you generate alpha in the short term, that is what adds up to the long term, right? And who on earth has been able to time the markets? Nobody. Even 5 months back, when markets first time crossed the 19,000 level, everybody said market is at a new all-time high. Let's not invest. You can't time the markets. You have to be adaptive to the markets and responsive to the markets.
True. And the question from Raghav was like, so you won't invest if a company is not fundamentally strong. And anytime you have max 25 stocks? Just one problem.
It's 25 to 30 is the range of stocks we have in the portfolio. And as I said, our investment process starts with eliminating 100 stocks based on liquidity, 100 stocks based on fundamental red flags. So after eliminating 200 stocks, we are left with 300 stocks. On those 300 stocks, we are combining fundamental valuation, technical, and all the factors that I told you to select the stocks. So it is not possible to find stocks that are going to be number one in terms of fundamentals. Our framework is invest in stocks that have relatively superior fundamentals, not the best fundamentals. For finding strategies with best fundamentals, there are a lot of other, investors and strategies out there which focus only on one factor, which is fundamentals to drive decisions. We want to take a multi-dimensional and holistic view to evaluate a security.
Okay. So on when you pick for stock picking thing, how do I define value factor when you pick a stock, and what are the metrics you look into?
I'm not going to share that, obviously, but I'll tell you very briefly what we do. We evaluate valuations on a very holistic basis. We have a fundamental method of valuation which considers standard metrics like, say, price to earnings, price to book, EV EBITDA, price to sales. And we also have some proprietary metrics which I will not reveal. We also have a technical way of looking at valuation based on relative price performance compared to the sector and compared to the markets. What we now do is we look at valuations versus past of that own company, peers of that sector, and the broader markets. To give you a live example, say an FMCG company is trading at a 50 ka P. So ideally, normally we would classify it as expensive. But based on the historic valuations of that company, say it was trading at 80 P 3 years back, it's now at 50. So versus its past, it's cheaper. Versus its peers, say the peers are trading at 80 to 90 P trailing, then versus that, it is also cheaper. And also versus the rest of the markets, it could be expensive or cheap based on the market cycle we are in. Say, for example, ITC, right? ITC was trading at a very relatively much lower valuation compared to the past, compared to its peers, and compared to the markets. And our models would capture that as a valuation score, like a high valuation score. And if we are in a value regime, we would give more weight to a stock like ITC. But if we are in a growth regime, ITC would not fall into the portfolio.
Okay. And one the other market question. Okay. What is your view on election result and reaction on the equity market and your portfolio and past experience? You want to answer this?
I can answer this, even though my models don't really care about any election result or any event such as that. What we care about is, so yesterday the GDP data came in. We've had a very promising GDP number at 8.4 for the third quarter. So that is a positive data point. My models are concerned with what to make of that data point. What does the market make of that data point? What does the investor sentiment make of that data point? And how all that adds up in a quantitative system rather than the subjective event that GDP data was released or election happened. If the volatility is increasing in the markets, if the breadth is reducing, if more stocks are making new lows, then my model knows that there is a lot of tension before the election. We don't need to know that election is happening. We just need to know the impact of elections on data points that we are looking at. Post-elections, breadth starts improving, volatility starts reducing, sentiment starts improving, advanced decline ratio starts improving, more stocks are making or fewer stocks are making new lows. That is enough data for us to say that, okay, the stress period of the market is over. Now we are moving on to a more positive side of the market.
Yeah, of course. I've got n number of questions falling onto the podium. If I'm going to take everything, I don't think the day is enough for me. So let me, take one last question for the day. So who do you think the ideal investor for this Aqua strategy portfolio?
Investors with a moderate to high risk appetite, because this is an equity strategy at the end of the day. It is not a debt strategy that will give you 8-9% fixed returns. First is moderate to high risk appetite. Second is at least a holding period of 3 to 5 years for the whole strategy to play out across market cycles. Third is investors who are seeking alpha. If you want market returns, this is not the strategy. Market returns and market volatility is significantly lower. If you want higher than market returns across market cycles, that is when you need to have an exposure to a strategy like this. Because this is flexi cap, we don't necessarily say that this is suitable for investors who seek a large cap exposure or mid cap exposure. All cap agnostic is okay.
Yeah.
But at the end of the day, it's an equity product.
And thank you, sir. Thank you for that wonderful PPT and patient for explaining all the things. Because we have come to the end of the session, I know there are a lot of questions which I haven't taken. Probably I might, send it via mail and I'll get them answered.
So do one thing, send it all via mail and my teams will respond to that.
Yeah. Thank you, sir.
Thank you so much.